So as U.S. markets trade down amid the growing concern over the spread of coronavirus, joining us from Miami is Clockwise Capital partner James Cakmak. James, you're saying that there are Cakmak. There are three negatives and a silver lining to all of this.
Right.
What is the silver lining?
The silver lining is I think we're going to get past this, and the way we get past it is people getting comfortable with a pretty ugly earnings picture. Because right now, if you look at 2020 consensus earnings for the S&P, right now it stands at about $175. We think that there could be a 10 to conceivably 20% correction lower from that. And if you look at that in that context, that implies that the market currently is valued at around 20 times earnings. So I think that what you're seeing right now is digestion of the market, that we are going to be in a very, very ugly earnings year. You can kiss the middle part of the year goodbye in terms of earnings and all the uncertainty as it relates to 4Q. So I think if you take 2019 as a baseline, cut off 10% from there, I think that's a reasonable base case measure. So from where we are now in the market, you're looking at, a reasonable 10% or so downside from here to say we're comfortable at those levels as a kind of bottom market call.
So James, do you then, so should you go on vacation until September? As somebody who's trying to make some investment recommendations and decisions, do you just kind of read the news and not do anything for the next 6 months?
No. I think we're increasingly optimistic. We had raised cash, heading into the coronavirus because of the fact that valuations were stretched, but we're starting to dip our toes in the water now. Because we do think that there is going to be a lot of opportunity to come out of this. When you look at where the VIX is today, it's at 48 or so. And these are levels that exceeded where we were back in the dot-com bubble. What you have to think about is, are we going to be in a situation where nobody basically leaves home at all, and the economy stalls? Or are we going to be in a situation where we have the systemic risk with the bond markets like we saw in 2008, 2009, and we don't think so. So we do think that we're going to get past this. It's all about how do we get comfortable with an ugly earnings picture, and I think that's going to be priced in sooner rather than later as companies slash their 2020 guidance outlooks in the coming weeks.
James, I guess I'm trying to understand what you mean by comfortable. A 10% downside seems, given how ugly the market has been, that's further downside still. So what do you mean? Just that we're going to have so many outlooks that people are going to just see this is a new norm? Can you kind of elaborate on that?
Sure. Look, if you have let's say, ugly 20% downward revision to 2020 numbers, that implies that the market is currently trading at about 20 times earnings based off of those lower numbers. And if you assume, further discount to the multiple from there, that implies an S&P in the neighborhood of 2,600 versus the 29 and change we're at right now. So I think, you take a worst case kind of earnings number, and also the fact that the market is not that expensive, relatively speaking, even on a big haircut to the earnings outlook for the year. I think you can wrap your head around that we're going to get past this, and it's not going to be a kind of disastrous recession type of scenario like we saw a little over a decade ago.
All right, James Cakmak is a Clockwise Capital partner. Thank you for being here.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.